Looking to improve your portfolio while paying less in taxes? Well, join me where I talk about investment strategies and techniques to help you reduce your tax bill and improve your overall portfolio. Welcome back to another episode of the Green Cards to Greenbacks podcast. My name is Nestor Vargas. I'm your host and a certified financial planner, as well as your Latino Money Man, as you may know me. I am delighted that you're here. Before we can dive into the techniques of how to lower your tax bill while investing, we need to better understand how we actually get taxed here in the United States. And so let's dive there. The way we get taxed here in the United States mainly is through either income tax or capital gain tax. And so income tax happens from wages like W-2 work, or if you're self-employed, you also have to pay taxes, but it also happens from interest that you may have from a checking account, a savings account, a money market, a CD, a bond. That is all considered income, and it gets taxed at your income tax rate, which we'll talk about in a little bit. The other way that we get taxed here in the United States is capital gain tax. And capital gains really is just a difference between the cost of what you paid for something and where you sold it. So if you bought something and you sold it at a gain, then naturally you have a capital gain. If you sell something at a loss, you have something called a capital loss. Alrighty. So we've talked about income and capital gains. Now, our income can be taxed as high as almost 41%, and our capital gains can be taxed as high as 24%. Now, these rates that I gave you include Medicare surcharge for really the top earners. Naturally, or I would say more popularly, capital gain tax rates, if you do it correctly, you will end up paying about 15%, which typically is much lower than what your effective tax bracket. So I just used two different words, effective tax bracket, that I also want to unpack. So our income tax rates are graduated. So there's different tax brackets. From $0, $10,000, you pay X percent, and then, it's just like little tranches. And the tranche that you're in right now, so your highest dollar, that's called your marginal tax rate, meaning what is your highest dollar getting taxed at. But when you really take a look at your overall income throughout the year, you will find that some of your income is taxed at a very low rate, and then it keeps going up and up and up. And then you average, so you add that up together, and what you see is your effective tax rate. So your effective tax rate is always lower than your marginal tax rate because, again, some of that income was taxed at a lower rate. Now that we understand that our income, or we are taxed at income tax brackets and then also a capital gain tax bracket, let's talk about the strategies we can use in our portfolios to really improve our outcomes by minimizing the amount of taxes, which is really a cost, right? It's a cost in our portfolio. Taxes are a cost. So we need to talk about how do we minimize that cost. And there's really two different strategies. There's the deferral strategy and there is the management strategy. And so let's talk about the deferral strategy because most of you will probably be more familiar with it. So the deferral strategy is, in fact, what you're trying to do is wait to pay taxes at a later day and time. You're deferring that to a later date. And one of the reasons people may want to do that is because while we're working, especially when we're probably kind of towards the top of our career, our tax rate, our income is typically the highest it will be. And as we talked about, your tax rate is probably going to be at the highest. And so if you don't need that income, what you want to do is you want to try to defer it to later years where your tax rate is going to be lower. So how do we do that? Well, some of the popular strategies is for traditional 401ks, traditional IRA contributions, so contributing money into the plans. And what happens is every time you contribute that money into the plan, basically that money doesn't show up on your tax return until a later date. And effectively what you're doing is deferring, right? So that's a really popular strategy. There's also the use of insurance products like annuities, life insurance. Those are also different techniques that can be used on top of your 401k, on top of your IRA. I would say that you have to be really cautious when you start using this insurance products because they tend to be oversold. Again, the product is not the bad thing, it's the people that are incentivized to sell these products where some issues happen. So be really careful when you start looking at insurance products. They're not bad. You just have to really make sure you're dealing with the right person. All right. So those are the deferral ways. We defer our taxes to a later time. There's also other strategies. And what I want to talk about is now the management, right? The management of your tax bill from your portfolio. So we talked about capital gains, and capital gains are triggered when you take action. Well, I should say most of the time. They're triggered when you take action. When you sell something is when that capital gain or loss happens. And so most people don't think about how we can actually use a capital loss. And the great thing about a capital loss is if you do it correctly, you can use that capital loss to offset any future capital gains. And therefore, what you're doing is you're basically not paying any amount in taxes when you do that. And when I talk about capital gains and capital losses, I'm primarily talking about portfolio capital gains and capital losses. One technique that is used widely is something called a tax loss harvesting. And the idea there is that because our portfolios are continuously fluctuating and we will be in scenarios where we are in a recession and our portfolios are probably down from where at the highest point, there are some of our investments, if we were to pop the hood open of our investments and look at our investments, some of our investments will be at a loss. And the technique there is to sell those investments that are a loss because we now capture that loss. Remember, the triggers when you sell. So you capture that loss, but you immediately buy something that is very similar in nature. So when the stock market returns, your portfolio doesn't stay at the bottom. It bounces back up. So your value of your portfolio doesn't get hurt, but you've locked in those losses. And then those losses are used to offset any capital gains in the future so they can carry forward. You don't lose them. You don't lose them in any period of time. It just carries forward. And that's really important, especially for folks who want to create income from the portfolio or have some purchases that want to make. Now, this strategy can be a little controversial because people will say that really all you're doing is basically pushing taxes down the road. And that could be the case unless you actually have a strategy where it's going to allow you to inherit, to gift the portfolio to some of your children or whoever you want. And if you do that, you indeed never actually end up having to pay the full capital gain taxes you otherwise would have had you just not done anything during a down market. Now, on the other side of that, it's also called capital gain harvesting. Why in the world would I want to sell my investments at a gain when I don't need them, right? Like, why would I want to create income? A really good scenario is if you're in transition between jobs and you are at a really low tax bracket. So if you're kind of mid-career, you find yourself being laid off and your income is much, much lower than it typically is, there's a good merit to really consider selling a portion of your portfolio at a 0% rate or at a lower rate than you otherwise would have to. And the capital gain harvesting is really good for many scenarios. You definitely want to talk to your accountant and you definitely want to talk to your financial advisor. You want to get that team together before you take any action in those scenarios. Now, the other thing that you can do when managing taxes is that if you own mutual funds outside of retirement accounts, those mutual funds will spit out something called a capital gain distribution. And really what is the investment manager, was buying and selling things throughout the year, and they are mandated by law to spit out any gains out of the mutual fund by the end of the year. So you could be sitting here with the mutual funds where you never sold anything, but you're getting hit with capital gain distributions. You actually will know when those capital gain distributions will happen. Talk to your financial advisor or go on the website of the company that manages your mutual fund. It'll tell you, hey, we expect this distribution to happen by this date. And so the action do you want to take there to manage that scenario? Well, two actions. One is if you're going to invest in outside of retirement account and you're going to choose mutual funds, make sure that you're looking at what their historical distributions have been, you don't want to be investing in mutual funds that are constantly spitting out high distributions. But the other thing is that if you indeed find yourself in a place where you have a mutual fund that's going to pay a really high capital gain distribution, then what you may want to think about is selling that mutual fund before that distribution happens to avoid that capital gain distribution. Now, you always have to consider what the tax bill is going to be by you selling that mutual fund and really weigh both of the options. Now, I constantly do that in my clients' portfolios, and we've been able to save them thousands of dollars by being proactive in managing capital gain distributions. The other option in managing taxes is talking about the bond side of your portfolio. So like the safety net, I like to call it the war chest. How you invest that war chest can also help you really manage your tax bill. So corporate bonds, or bonds that are issued by corporations, are taxed at both the federal and state level, but municipal bonds are taxed differently. So using municipal bonds in a portfolio outside of your retirement account can help you reduce the tax cost in your portfolio and really put you in a better position as you start looking at your portfolio return. And then as we start withdrawing money from our portfolios, it's really important to consider all of the different accounts that you may have. So that's called distribution management, because you may have accounts that are retirement accounts that are taxed fully when you take the money out. You may have a Roth account that has already been taxed, so that money is going to be tax-free. And then you may have a brokerage account that is taxed at typically capital gain rates. And so let's say you need $50,000 and you're retired or you're in between jobs. How you mix those different account types, those withdrawals, is really important, because that can really put you in a position to really pay a lot less in taxes than you would have had you just chosen one particular account. I will create another episode about distribution management, because that really is an episode in itself. But just know that it is something that you want to be aware of. And really, what I'm doing here is giving you the awareness of what's available. You don't have to be an expert. You have to be aware, right? Talking about tax distribution management as well, it's really important to also understand that just because you hold, let's say, I'm going to use an example, Apple. I'm not recommending Apple, by the way. Not that I think it's a bad thing, but again, this is educational in nature. Let's say you have Apple. Just because you own Apple, it doesn't mean that every single little share that you have of Apple will produce the same amount of tax liability. Why? Because you may have bought Apple in different instances, and each instance has a different cost. Also, you may have had the dividends that Apple spit out. I don't know if Apple spits out any dividends, but let's say it did. Those dividends get reinvested if you had them reinvest into additional shares. And so when you look at your investment account and you see Apple, just know that that is just really very high level. There's something called tax lots. So if you open up the hood, if you look at the reporting, you would be able to say, hey, this amount of shares were purchased December of 2023. This other shares were purchased January of 2023. I'm just giving you examples, right? And you would see that each tax lot has a different consequence. So just know that as well, that if you're going to sell something, that's the same thing with mutual funds and thing with ETFs, is that tax lots matter. Tax lots matter. All right, my friends, we have talked about the two different ways we get taxed here in the United States, primarily income tax rates and capital gain rates. We have talked about the ways people can defer taxes to the future years where they think the tax rates will be lower. And then we've also talked about different ways to manage your tax liability. All of this, remember, is to reduce the overall cost of your portfolio, because taxes are a cost. We can reduce cost. We get better performance because as we get more money, right? It's not what you made, but what you got to keep. It's called after-tax returns. That's what you really are. It's really important. So I want to give you two actions. I want you to think about your portfolio, and I want you to think about what are you investing in? Where are you investing those accounts? What type of accounts you're using. Make sure that you're using the best accounts possible. And two, before you withdraw money from your portfolio, think about which accounts you're going to use. And then also remember that the different tax lots available. And don't forget about tax loss harvesting, also tax gain harvesting. Those are really important. I hope you found this episode special. I hope that you found it helpful. And let's go make those greenbacks. Bueno, pues. I hope you guys enjoyed this episode. I want to go ahead and ask you to please send me any questions you may have or any topics you want me to talk about. Go ahead and send them to Nestor, Nestor, at greencardstogreenbacks.com. I actually read every email you send, so I'd love to hear from you. Don't forget to head over to greencardstogreenbacks.com for the show notes for this episode, and really links to any resources we may have discussed. Bueno, amigos y amigas, nos vemos pronto. Let's go make those greenbacks.